Hey y'all, Zach McDonald, your real estate agent with Real Property Associates, and today we're going to talk about selecting the best offer in multiple offer situations. Before we dive in, I want to preface this video by saying it is mainly geared towards sellers, as we're going to talk about how they can select the best offer in multiple offer situations. But for buyers, I think there's value here as you can listen to my advice to sellers and see how that maps over to you as a potential home buyer. There are a few other videos I've made, one on how to win competitive offer situations, and as well as talked a little bit more about the difference between buyers markets and sellers markets. So there are other resources available on my channel, so please consider subscribing. The first thing as a seller that you should be looking for in an offer is the price. Now, out of all the different things, this is usually the thing that sellers are most concerned with, and that's how much money am I going to get? And I agree that the price is really important because ultimately you're selling your house to make money and walk away with the most amount possible. And that's almost every single seller's goal. I can't say that's every seller's goal, but the majority of people are looking to make the most money possible. But I want to add something to that, and it's the most money that you can get, but there's another piece to the puzzle, and that's how sure are you that you're going to get this money? How solid is the deal, so to speak? So you've got this money factor over here, which is important, but you also have the other parts of the contract and the contract itself. And we'll be looking at two other things, terms and contingencies. In the Seattle area, the market that I help people buy and sell houses in, it's highly, highly competitive. And that's because we have a lot of people that want to buy here and not enough houses on the market to keep up with demand. Well, at least hardly enough houses to keep up with demand, which creates this competition and frenzied-like pace in the market. And it gives people that are looking to sell their house an opportunity to essentially choose which buyer they want to work with versus choosing just to accept an offer. In a buyer's market or in a different market altogether, you're going to have less ability to choose. So this video might not be relevant if we're in a time where maybe it's taking 2 to 3 months to sell a house. But currently in Seattle, we're hovering right around 1 to 2 weeks. And so you have a lot more choice as a seller on who you choose to work with. So we talked about price at the beginning of this video. Price is in everybody's mind number one, but these other two things, terms and contingencies, are going to be highly important to consider. So let's talk about terms in a real estate contract. Now, the contract typically is a 5-page document that has multiple addenda attached to it. And so when we talk about terms, we're going to be talking about specifically what the buyer is offering you aside from price in the offer. So that's going to be things like closing timeline, what the closing date is. It's going to be the earnest money amount, how much they are essentially putting forth as a good faith deposit. And there are lots of other terms that can be talked about. I'd say those are the two biggest ones that we're talking about. In a condo situation, you'll have typically an HOA as well. And so there'll be terms related to the HOA, how long they have to review documents and things like that. But we'll focus mainly on earnest money and closing timeline. Now, as a seller, the good faith deposit, the earnest money deposit, is essentially what you get if a buyer defaults on the contract. And the buyer is going to protect this money with contingencies, and we'll talk about that in the next section here. But the earnest money amount is typically somewhere between 2 to 3% of the purchase price. So if we're talking about a $500,000 house, we're talking about $10,000 to $15,000. If we're talking about a $1 million house, we're going to be talking about $20,000 to $30,000. And in competitive situations, sometimes we see even higher earnest money amounts. In Washington State, and each state has different rules, but in Washington State, the rule is 5% max. So buyers cannot put more than 5% down as earnest money. Well, sellers can't keep more than 5%. So that's typically the max that you'll see on earnest money amounts. Sometimes buyers will actually elect to make that earnest money deposit non-refundable. So they will go ahead and allow the seller to keep that money and not give it back. They'll release it to the seller early. Typically, the escrow company holds on to the earnest money throughout the duration of the transaction. And this earnest money is deposited early on, typically within the first couple days. and then it's kept by the escrow company. So if a buyer is willing to release earnest money to you, that's a great sign. Now, very uncommon, I'd say, but in those highly competitive situations, occasionally that happens. And usually it happens when there are no contingencies on the contract, which we'll talk about here in a second. The other thing that we'll just sit on here as far as terms go is the closing date. Now, as a seller, you probably have a different situation than someone else. Some sellers, like investors or somebody who's already bought another house or moved out of the area, they're typically looking for a quicker closing date. So if somebody can give you your money in 21 days versus 45 days, that's a significant amount of time. And so if everything's the same or close, sometimes that's more desirable. On the other side, if you need to live in the house after the closing date and stay in the house for 1 to 2 months to make yourself a more competitive buyer for your next purchase, or maybe you just need a few extra days to move out after closing, that would be something that potentially could be added into the contract from a buyer in a multiple offer situation. You might see a buyer try to add those terms into the contract to make the contract more favorable to you. And what we find in these multiple offer situations is that buyers are trying to make their offer the most appealing they can to the seller. So if you're watching this video and you're a seller, you should be excited, especially if you're in a seller's market like we find ourselves in right now in Seattle, because you ultimately get to dictate a lot more in this process than you normally would. So you have special requests or things you'd like. If you want to keep your washer and dryer or your fridge instead of giving those to a seller, which in Seattle is pretty common to pass appliances along to the next owner, and everybody's doing that, you kind of get the new appliances wherever you go. I've had multiple clients be able to keep those appliances and they still get the full price offer or more. So that's something, again, another term that you can add into the contract. Overall, in a seller's market, it's a lot easier to get terms that are favorable to you as a seller. And it's really important that we dive into those on the specific offers and not just look at price, but also look at terms. The last thing we're going to consider here are the contingencies that buyers include in the contract. And when we look at these contingencies, buyers have a myriad of different contingencies they could include in a contract, but here are some of the common contingencies. First of all, financing. Most buyers are going to be financing their home purchase, and it could take the shape of lots of different things. You could have conventional loans, you could have VA loans, you could have FHA loans. There are lots of other types of loans, but those are the three most common ones that we see in our market. And the other thing you'll be looking at is down payment amount. How much are they putting down? Are they putting down 3%? Are they putting down 0% in a VA situation? Are they putting down 20%? Are they putting down 50%? There are lots of different options on that piece as well. And something to consider with financing is how far along are they in the process? Are they new to the financing process? Have they been approved already with their lender? Have they been underwritten already? Sometimes lenders, specifically local lenders and people that have already been in process for a little bit, will have what's called a pre-underwriting on their loan file. So they're farther along in the loan process and they're more of a sure bet, essentially. But those are all questions typically we will ask a lender prior to advising on an offer. We will talk to the lender, get that information, figure out where they're at, and be able to convey that to clients. So we're looking at the whole picture on the financing side. Now, what happens sometimes in competitive situations is buyers will maybe elect not to include a financing contingency. They might remove that contingency altogether and essentially put their earnest money at risk if their financing doesn't come together. Now, a lot of buyers won't do that. They're not willing to waive that contingency or proceed with a purchase and potentially lose their earnest money over failed financing. But in other cases, buyers are willing to do that. And usually those buyers are the more qualified buyers, or the buyers that have more cash or flexibility in their situation. Other things a buyer might do in the financing situation is remove the contingency for an appraisal. And the appraisal contingency is, I'd say, one of the bigger parts of the financing contingency. Essentially, it's a clause in the contract that when the bank has a third party go out and essentially do a valuation for the property, if the third party says, the value's not here, we can't support the price of $1 million, we think the house is worth $960,000, all of a sudden you can't complete the purchase, especially if you don't have the extra cash to make up the difference. So a buyer that has that contingency, the appraisal contingency, or just a financing contingency in general, is going to be able to fall back on that, potentially back out of the contract. It's an opportunity for them to get out and they get their earnest money back. And so as a seller, if a buyer doesn't include an appraisal contingency or doesn't include a financing contingency, it's better for you. It's not as good for them, but it is better for you. And so that's one of the things that we'll be looking at in the offer. Are they including a financing contingency? And if they are, what are the terms of that contingency? Now, some of these other contingencies we'll talk about include the inspection contingency. This is probably the number one way that buyers get out of a contract is on their inspection contingency. So buyers in a normal situation will include this contingency with their offer, and it allows them to inspect your home for between 5 to 10 days after they are under contract on the house. So buyers are going to bring in a professional inspector. The inspector is going to go through the house top to bottom, look at system structure, etc., and make recommendations to this buyer what they should be asking for, or at least what issues there are with the house. And when I'm working with buyers, we'll consult on those different items, what's important, what's not important, and help them process through for them what the most important things are, and then present those things to the seller. And so as a seller, you're now in a situation where you have a buyer under contract, but this buyer now has new requests. They don't always make requests, but a lot of times they do. And now you're going back and forth again. And in this situation, the buyer could back out if you're not willing to agree to what they want. And a lot of times there's some back and forth, and there's some, maybe the buyer only gets a little bit of what they want, but they still are willing to move forward. Other times the buyer says, take it or leave it. We need all these things done. And sometimes you have to walk away from that deal. But again, the buyer gets their earnest money back. So in a competitive situation, we're looking at the earnest money amount, right? And we want to get that if we can. And so the inspection contingency is one of those things protecting the earnest money and also allowing a buyer to back out. So when we're looking at multiple offers, we're hoping that a buyer has maybe done what's called a pre-inspection, which is where they have already done an inspection before making their offer. So they've come in, they had their inspector come in. Sometimes the seller does an inspection ahead of time. We could talk about that. It's a little different, but I did a video on that recently as well. You can check that out. Or the buyer doesn't include an inspection contingency at all. That's the other benefit. And sometimes when there's multiple offers, buyers do crazy things and they're willing to purchase a house without doing an inspection altogether. This happens most often in houses that are just terrible condition, where you just know from looking at it that there's a lot to do. And you just know going in that you're going to have a lot of work. Or in a situation where the house is in really, really, really good shape. It's less common in those in-between situations where there looks like there's some deferred maintenance, but we're not sure how much. You don't see as many waived inspections there. So there's things that you can do up front to either help facilitate the pre-inspection process or incentivize buyers maybe to not include that at all. But we're definitely looking for an offer that doesn't have an inspection contingency. Another contingency that's worth noting is an HOA contingency. This is a contingency essentially on the homeowners association, and most commonly found in condos. Condos all have HOAs, and buyers want to know what they're getting themselves into. Because in a condo situation, they're not only buying the unit itself, but they're buying into the homeowners association and the condo complex as a whole. So in a condo situation, a seller is going to provide the buyer with a resale certificate, which will include a disclosure about the condo, but also a lot of other documents to support that disclosure. It's going to be budgets, meeting minutes, HOA rules and regulations, etc. And so as a seller, you can provide this information up front to a buyer and help them get that information they need up front. And sometimes, if it's competitive, they'll waive this contingency altogether. It's one of those, though, that as a seller of a condo that you do have to allow in certain situations, even when it's competitive. Some sellers will elect not to order a resale certificate until the house is under contract, and that's mainly because they only last for so long. And so if you get it earlier and that condo doesn't sell right away, then you find yourself having to reorder this resale certificate and pay additional money to get it again. So some people elect to wait. I typically advise getting it done earlier unless we're pushing the price a little bit and we know it. In that situation, we can adjust, but typically it's good to get that disclosure up front so that we can provide it and hopefully remove that contingency. Now, depending on where you live, if you live outside of the city limits, if you're a little farther north or south, you're going to have different contingencies included. Things like a septic addendum or a well inspection. You might see some of these in more rural areas. Now, in Seattle itself, you don't typically see these things. If you get outside of the city, you do, the farther you get out. And in other markets, maybe it's just standard to have a well or a septic system. But in Seattle, we have public sewer, and in a lot of the surrounding suburbs, we also have public sewer systems. So not as common to see it, but we see it regularly as we head outside of the city. The moral of the story here for sellers, though, is that all these different contingencies are opportunities for the buyer to do research and potentially back out. So in competitive situations or situations where we know it's going to be competitive, we try to, first of all, provide the buyer with all the information they need up front so they can remove these contingencies possibly. But additionally, as a seller, you have the option to choose who you want to buy your house. And so when we're looking at these offers, we're not just looking at the price, we're also looking at and advising on the terms in the contract and also the contingencies in a contract. As a real estate agent, my job is to help you as a seller make the best decision you can with the information that's been provided. Now, there are still situations where in competitive situations that the deal doesn't come together for some reason. But what we're trying to do is minimize the chance that a buyer is going to default or back out of the contract, and you, as a seller, get the most amount of money, but also the most amount of assurance that a deal is going to close. Thanks so much for watching this video on how to select the best offer in multiple offer situations. Again, we looked at price, terms, and also contingencies. If this video was helpful for you, or you know somebody who it would be helpful for, please give it a thumbs up and consider sharing it with them. Thanks so much.